If you're trying to analyze commercial real estate the same way you did just 5 years ago, you're basically playing a completely different game now. The old playbook, the one that said, just watch the central banks, well, you can pretty much throw that out the window. A whole new set of rules is in play, and they're all about physical limits, not financial tricks.
For decades, I mean literally decades, the entire industry just spun around trying to guess the next interest rate move. But that era, it's over. Right now, the single most important factor, especially up in Canada, is structural capacity. We're talking the actual physical ability to house people and move them around. That's what drives the economy now.
And this is not some temporary trend, right? This is a fundamental change in how the market actually works. So over the next few minutes, we're going to break down the 4 critical new rules that you absolutely need to know. Okay, so let's dive into the 4 big forces that are reshaping demand right through 2027. We're going to break down how each one works on its own, and then, more importantly, how they all start to connect and interact.
First up is the big one, the most dominant factor of them all, the affordability ceiling. And look, this isn't just a social issue anymore. It has become the single biggest roadblock for commercial real estate, and it's a real double-edged sword.
So on one hand, as buying a home gets further and further out of reach for people, it creates this incredibly powerful, steady demand for multifamily rentals. That's the anchor. But on the other hand, it acts as a huge barrier. Think about it. If your workers can't afford to live anywhere near your office or your warehouse, your business just can't grow. It hits a wall.
Now, what's really fascinating here is how you can see the money responding to this. Investors are literally chasing affordability. They're rotating capital into the prairies. We're talking cities like Calgary and Edmonton. And why? Well, because they're seen as the last places where you can still find labor-driven growth. All right, let's move on to the second factor and see how this all starts to build. Because it's not just about affordability in one city, it's also about how easily people can move between them. And in Canada, that is a real maze. This number right here is a huge deal. It's estimated that all those barriers between provinces, things like different professional credentials, they actually reduce how much workers can move by 7 to 12%. That friction keeps people stuck, and it artificially pumps up demand and labor in just a few already super expensive cities.
And this just perfectly illustrates the difference with the U.S. market. You see, south of the border, labor is way more fluid, and that lets demand spread out to new growth areas like the Sun Belt. But Canada's structural friction means our growth potential gets trapped, and eventually it just stalls out.
Okay, our third factor is something we have all been living and breathing, the rise of hybrid work. This isn't really a debate anymore, is it? It's a permanent reality, and it has split the office market right down the middle. I mean, the data couldn't be clearer. With about 55% of the workforce now in some kind of hybrid model, the market is really bifurcated. You've got clear winners and clear losers, and the big dividing line is all about the quality of the space.
So on the winning side, you have what's being called the experience office. These aren't just buildings with desks anymore. No way. They are destinations. They're collaboration hubs with high-end amenities, designed to be so cool that they actually make the commute worth it for employees.
And the financial impact? It's massive. These top-tier, transit-connected experience offices are commanding a staggering 20 to 30% rent premium over your average office space. The flight to quality is real, and you can see it right there in the price tag.
But of course, that flight to quality has a flip side, the commodity office. This is your older Class B or C space. The less prestigious buildings with fewer perks, especially the ones that are a pain to get to. As companies shrink their footprint into fewer, better locations, these buildings are facing permanent obsolescence.
So, what's the bottom line here? For an investor, holding on to these assets is an enormous financial gamble. An office that's more than a 10-minute walk from a major transit line now carries what's called a massive stranding risk. And this brings us to our final, and maybe the most critical factor of all, the hard, physical limits of our infrastructure. This is really where ambition meets cold, hard reality. I mean, you can have all the demand, all the investment capital in the world, but if the underlying grid can't power your building or the transit can't get people there, growth simply cannot happen. It stops, dead in its tracks. Infrastructure has become the ultimate bottleneck. And you know what? There is no better example of this than the AI boom and the absolutely ravenous demand for data centers. For this sector, the whole way they choose a site has been turned completely upside down.
This is it. This is now the first and most important question. It's not how much does the land cost, it's can we get enough electricity to this site? The availability of power has become the #1 filter for all new industrial development.
And this has created a whole new term you need to know,
the megawatt premium. Investors are now forced to analyze and underwrite megawatt availability just as seriously as they analyze square footage.
And we're not talking small potatoes here. That premium is significant. Sites that come with 10 megawatts or more of pre-allocated power, they're trading at a 15% premium over traditional logistics space. And here's the key. This premium holds up no matter what interest rates are doing.
Okay, so let's tie this all together. Because here's the thing. These four factors don't exist in a vacuum. Their real power comes from how they interact, how they compound each other, and create a totally new map for real estate investment.
So look, when you combine poor affordability with low mobility, growth just stalls. It's that simple. When you combine hybrid work with great transit, demand funnels into just a few prime spots. And when you look at industrial, it's power availability that's creating entirely new regional winners, totally independent of their old market size.
So at the end of the day, it all comes down to this. The old game was about predicting the central bank. The new game is about understanding the grid, the transit lines, and the housing supply. So the question every investor has to ask themselves now is, are you still betting on interest rates, or are you betting on infrastructure?